Howdy, everybody. Welcome to Liberty Call. Today is Monday, January 13th, 2025. Hope you're having a fantastical day out there in the interwebs. It was a sunny day here in Colorado. Looks like the clouds have kind of come over the horizon, but it is cold outside. It's like mid to low 30s. I apologize for being a little bit late today, about an hour behind. I had to run in and my beard's a mess. Had to run into town, get mail, and run some errands, and grab some groceries on the way back. So again, hope you had a great weekend. As we get ready to jump in, the U.S. labor market is staying hot with job growth blowing past expectations and keeping rate cuts off the table for now. Goldman Sachs is shaking things up with a major restructuring, while JP Morgan's Jamie Dimon hints at becoming chairman after stepping down as CEO. Meanwhile, the UK's financial regulator is turning its attention to private markets, and major U.S. banks are set to report earnings, with analysts expecting more good news. Even Deutsche Bank is getting some love with a ratings upgrade. So let's dive in and break it all down. But before we do, I need a favor from you. Give me some thumbs up, a like, share, subscribe, a follow, and press that notification bell. All right, well, now we can get into the markets. Let's see here. Dow Jones finished. Why are these markets not updated? That's weird. These are today's. All right, well, we'll just go over here. We'll come over here to this. Let's see here. The Dow Jones finished the day up 0.86%, 358 points. Closed at 42,297. The S&P 500 was up 0.16%, 9 points, closed at 5836. And the NASDAQ down 0.38%, 73 points, closed at 19,088. So let's get the rest of these back. Yeah, wrong screen. There we go. All right. The VIX was down 1.79% today. It's at 1919. Canada down 1 point. Why are these not updated? This is weird. I'll skip that. Mexico was up 0.52%. Boy, I'm all disjointed today. All right, let's hop over to Europe, and some of these aren't even updated either. Germany was down 0.41. The UK, I'll skip that. France, skip that. The Netherlands down 0.58. Spain down 0.28. Italy down 0.83. Switzerland down 0.59. Portugal up 0.75%. Russian exchanges, MOEX up 1.55. RTSI up 0.76. And the overnight markets, they're all a mess too. I'm going to skip them too. All right. So much for the markets. I apologize, folks. I do not know what the problem is with investing.com's times here. See if I put in the extended, compact, no, normal, performance, technical. I don't know. Not important. All righty. Well, let's hop into the weekly economic update and see what happened there. It's a little too big for me to read. All right. Stocks fell for the second consecutive week as a round of fresh economic data stoked inflationary fears among investors. The S&P 500 declined 1.94%. The NASDAQ dropped 2.34%. The Dow was down 1.86%, and overseas markets slipped 0.49%. Stocks rallied broadly to start the week, but two economic reports on Tuesday, job openings and the prices paid index among service companies, raised fresh inflation concerns. Higher treasury yields also put pressure on stocks. Stocks flattened out on Wednesday. Investors reacted to news that most FOMC members agreed inflation risks had increased per minutes from the Fed's December meeting. We covered that last week. If you want to go back and catch up on my notes there. The U.S. stock markets were closed Thursday in observance of President Jimmy Carter's funeral, and on Friday, a warmer than expected December jobs report caused investors to question whether the Fed will adjust rates at all in 2025. News that consumer sentiment ticked down also pushed stocks lower. All right, when good news becomes bad news, the economy added 256,000 jobs in December. If you believe the numbers, 100,000 more than economists had expected. That's the second highest monthly job gain for 2024. Unemployment ticked down to 4.1%, which was also better than anticipated. Job growth and lower unemployment signals good news for the economy, but bad news for markets. A stronger jobs market puts less pressure on the Fed to adjust rates, especially with inflation top of mind among investors. Key economic data this week. Monday is the Treasury statement. Tuesday, we have the Producer Prices Index, and Fed officials Jeffrey Schmidt and John Williams are speaking. Wednesday is the Consumer Price Index. Fed officials Thomas Barkin, Neil Kashkari, John Williams, and Austin Foolsby are speaking, and the Fed Beige Book. Thursday, retail sales, import and export prices, business inventories, and home builder confidence index. And Friday, housing starts and permits and industrial production. Companies reporting earnings this week. Wednesday, we have JP Morgan Chase, Wells Fargo, BlackRock, Citigroup, and Charles Schwab. Thursday, United Health Group, Bank of America, and Morgan Stanley. All right. Well, that's the weekly update. You feel smarter out there, folks? I know I do. All righty. Let's jump into today's market recap. S&P 500 ends higher as cyclicals offset tech wreck. All righty. The S&P 500 ended higher on Monday after recovering earlier losses driven by gains in cyclical stocks like energy and materials, which offset declines in tech. Investors shifted out of growth sectors amid rising concerns about the Federal Reserve's potential pause on rate cuts, just days ahead of key inflation data. Energy and material stocks led the market rebound as investors moved out of tech. Rising oil prices supported gains in energy companies like Valero and Baker Hughes and Schlumberger following U.S. sanctions on Russian oil exports. Semiconductor stocks, including NVIDIA, dragged the tech sector lower after the White House announced new export restrictions on AI chips to countries like China. Tech also suffered from rising Treasury yields and diminishing expectations of multiple rate cuts from the Fed this year. The upcoming December Consumer Price Index report will be closely watched as economists expect a 2.9% year-over-year rise, up from November's 2.7%. You remember when they said we were down to like 2.5%, and they're like, yeah, we're almost to 2%. It's going back up, folks. I was telling you this last summer. The Fed remains cautious as inflation still exceeds the 2% target and is projected to rise to 2.5% in 2025. Earnings season is kicking off. The fourth quarter earnings season will start with major Wall Street banks reporting this week, including Chase, Wells Fargo, Goldman Sachs, and Citigroup on Wednesday. Bank of America and Morgan Stanley will follow on Thursday. Macy's stock dropped 8% after issuing a weak sales forecast, while Abercrombie & Fitch fell 16% despite lifting its sales target. Moderna shares plummeted 17% after lowering its 2025 sales forecast, citing slow demand for its RSV and COVID-19 vaccines. RSV is just the croup. I've had the croup, well, not so much in my adult life, but I had a lot as a child. And it's just basically, hacking up phlegm and stuff. I'm not sure why people freak out about it. I mean, renaming it RS, well, that's probably the technical name. But anyways, this week's earnings and inflation data are expected to shape Wall Street's next move amid ongoing rate concerns and profit-taking pressures. All right, so that's the market recap. One last article here. I know I'm going fast, simply because I'm behind today. All right. This comes from First Trust. It's the Monday Morning Outlook from Mr. Brian Westbury. This week's article is titled The Housing Outlook for 2025. All right. The U.S. housing market continues to grapple with a long-term trend of underbuilding, a key factor driving home prices despite broader economic headwinds. Again, if I could pause here, if we deported there's probably 100 million illegal aliens in the country at this point, kick them all out. I mean, that's probably easily 25 million homes that would free up like that. Since the housing bust of 2007, with the exception of a brief period during COVID, the U.S. has consistently built too few homes to meet population growth and offset scrappage from demolitions and natural disasters, like in California. Housing starts in November of 2024 came in at an annual rate of 1.289 million, well below the estimated 1.5 needed to maintain balance. This ongoing shortage is expected to push home prices higher in 2025. The National Case-Shiller Index showed a 3.7% annual increase through October of 24, and similar growth is anticipated this year. In 2025, single-family home starts rose by 6%, but multifamily starts plummeted 25 to 30%, hitting a decade-low pace. However, multifamily starts are unlikely to drop further in 2025, with a slight rebound expected. Single-family starts should also see a continued gradual growth. This increase in construction activity is projected to moderately boost new home sales, which rose by 2% in 24 and are expected to grow similarly this year. Existing home sales are forecast to remain stable at around 4.05 million annually, as home owners are with ultra-low mortgage rates from 2020 to 21 are hesitant to sell. Builders of new homes can adapt by offering lower price models to attract buyers, a flexibility that doesn't apply to existing homes. And the outlook overall, the U.S. housing market is far from a bubble and appears resilient enough to weather a potential recession. With ongoing housing shortages and various economic dynamics at play, the sector is expected to see modest improvement this year in 2025, even as the broader economy slows. All right. Well, again, like I said, there are some ways we could free up some housing. I mean, I don't know if you want to live in an illegal alien's house, but it would certainly take the strain off of all the people here. So, all right. Well, that's everything I had to cover for today. If anyone needs to get in touch with me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a buzz. I'd be glad to help. All right. Well, hope everyone has a wonderful evening, and I'll talk to everyone next time. Adios.